Sebastian, what is the playbook for investors right now around inflation?
Look, there's a lot that's priced in, and you just heard commentators talk down inflation. The forecast for tomorrow is 7.3. We're looking at two opposing forces with inflation. You were just talking about autos, energy, what I call COVID distortions. Those are working themselves out. You can't get autos go up another 40-50%. I don't think you can get energy go up another 40-50%. But then you have stickier inflation rearing its head. That is wage pressures and rents. So tomorrow's sprint will be very interesting from that perspective.
So take that thesis and then extrapolate what it means for Fed policy action and what is or is not priced into the market already.
You know, you have at least 5 hikes now priced in. Some are discussing the possibility of a 50 basis point hike. I think that ultimately, if we look 12-month out, which we tend to do as asset allocators, the direction of rates is higher. For us, it means we're positioned long value stocks. And look, the Fed has said they will be flexible. And it was initially interpreted flexible. They'll give themselves room to hike more and be more aggressive. But it could also mean that the Fed will be flexible. They're ready to step back if the economy slows down more than expected.
Sebastian, what is aggressive defense? Because once upon a time, large cap growth stocks was aggressive defense, and you're saying that's not going to be the case in 2022.
Yeah, I think we're seeing this year to date. Now's the time to redefine defense, right? We all thought large mega cap growth stocks helped play defense in the portfolio. That hasn't been the case year to date, and part of it is the inflation picture and rising rates. For us, when I say we're playing aggressive defense, is that overall the market is pricing in a lot. Valuations are high, corporate margins are pretty high, and we're withdrawing liquidity. So on the margin, we've reduced our stocks allocation, not by much. We like to remain invested, remain diversified, but we've reduced our stocks allocation. So we're playing defense, but we're playing aggressive defense because under the hood, we're actually long what we consider an underpriced recovery trade. That includes value stocks and small cap stocks, for example.
So it's all in the allocation. So what are you increasing your weighting toward if you're decreasing your exposure to stocks?
So when we sell out of stocks, these days we don't really like investment grade bonds. We prefer a little bit of cash and also bank loans. Bank loans are interesting. You know, it's an asset class that it really is the asset class of choice when rates rise historically. It's actually made money 22 out of the last 23 years. It has relatively low default rates right now, and it gives you a yield of 4 or 5%, similar to high yield bonds, but with much less interest rate sensitivity. In fact, it's got a negative correlation with treasuries of minus 30%. So this is where, again, around the theme of aggressive defense.
Sebastian, thank you. Appreciate it. Sebastian Page of T. Rowe Price. We are counting down to a huge afternoon of earnings with results ahead from Disney, Uber, Mattel, and more, plus a first on CNBC interview with Disney CEO Bob Chapek ahead of his call with analysts. And after the break, lawmakers taking a big step toward prohibiting members of Congress from trading stocks.